The impact of COVID-19 on our economy and on global markets continues to take form, with the worst of the health risks apparently behind us locally. But the shape and timeline of the economic recovery is still a matter of conjecture. An update on our thoughts and suggestions for these extraordinary times. In normal conditions, we would have had the May federal budget this week. However, there's little point in budget forecasting for the forward estimates in a global pandemic. So it's been deferred to October. And similarly, despite a wide range of economic forecasts in the public domain, a more realistic approach to consider is a range of scenarios and to be prepared for this range of outcomes. Our Reserve Bank, in their recent statement on monetary policy, updated their base case for growth, employment and inflation, but sensibly added scenarios to their new core forecast, which, not surprisingly, shows a dramatic 10% fall in GDP from February's estimates, but does have a V-shaped recovery in their upside scenario versus a U-shape at best for the downside. There are so many unpredictable factors that will feed into the ultimate outcome, but it's important to consider that not all the surprises will be downside ones. Certainly, the effectiveness of the decisive COVID-19 policy response here in New Zealand and in many parts of Asia is a very pleasing surprise. And so, the reopening of our economy is happening sooner and with less risk of a second wave of infections, a stark contrast with parts of Europe and North America. But the virus and the necessary containment measures have had a profound impact on employment, and we'll see a very sharp rise in the unemployment rate later today, perhaps to 8% on the way to 10%. Again, the RBA base case, in pink, shows a gradual recovery next year, and the upside scenarios have a faster return to near 5%. But these forecasts will offer little comfort to those already impacted. The downside scenarios are hard to ignore when you consider how long it will take until international tourism returns, the risks of a reignition of trade wars, the unknown impacts of the virus on global supply chains, and, for property prices, the extent of falls for residential and commercial property. Consumer demand and preferences are likely to be fundamentally different, but that may create, for example, a surge in demand for regional property. So, the post-COVID economy may demand rapid adaptation for businesses. Meanwhile, stock markets have continued their recovery from the late March lows, and in the case of the US Nasdaq index, are only around 10% below the February the 20th highs. So, this underscores the wide range of estimates of valuations for businesses and how they may be impacted in the medium term by COVID-19. Having technology and innovation on your side will be so important for businesses in the recovery period, as will adapting to new consumer choices. And lastly, the poor economic data will be capturing the headlines for a while, but it will be lagging the health recovery and the economic recovery, whose shape is nigh on impossible to predict, but the key may not be how far the tide goes out in this severe economic contraction, but how long it stays out for, which, who knows, may pleasantly surprise us. And that's the market update from Leveraged.